So first thing I want to talk about is a simple moving average. This is the mathematical formula used to comprise it. So all technical analysis, I'm going to make a differentiate between technical analysis and price action. I separate the two, however, they're both considered technical analysis because they do analyze price. Technical analysis is going to all be mathematical formulas. So these are your Bollinger Bands, they're all comprised of mathematical formulas. They're just taking the price, doing some formula like this, and then spitting out a different price. So that's also another problem with this type of thing is lag. Because you're doing these steps to it, it's going to have a data lag to it because it's not down to a point. So these simple moving averages are going to be a little bit behind. They're going to have a little bit of lag sometimes. But it's just your basic average formula. It's just taking, so say you have a 5, you want to look at a 5-period simple moving average on the daily chart. So it's going to take the last 5 days prices and divide it by 5. And that's how you get your simple moving average. This all seems really common sense, but I think it's important to look at the formulas and try to understand what they're doing. So most of y'all are advanced traders. I'm going to start going over simple moving average crossovers. I feel like a lot of people overlook simplified trading strategies like this, and they're extremely useful. This is a great point to start if you're brand new to technical investing. What it basically does is, this is our simple moving average right here. So this kind of acts as a trend line. A lot of you were here for the trend line. This is basically a trend line. So you can see the stock price bounce at particular points. On different charts, you'll actually see it come down and touch, and then it'll find support there and start rallying. This is just a simple strategy if you want to incorporate a little bit of technical analysis. So what you're going to do is you're going to buy whenever the price actually breaks down below. So you would start monitoring the stock here, and then you'd want to buy whenever the price closes above the simple moving average. So this is an easy way that you could use technical analysis to time your entries. So if you were waiting, it broke down, you would buy right here, and then you would hold it until the stock closed below the simple moving average. So you can see in this particular trade, this would have been very profitable because you would have bought way down here, and you would have sold way up here. So sometimes it won't work. You need to look at the charts, and we'll go into how you can make sure you're using the right simple moving averages on particular stocks. Any questions about this? You can also use it the other way. So I use economics to try to tell me where the market's going to go. So I can say, okay, the tax cuts are going through, the economy's growing at a great point, I want to look for buys. And then you can use technical analysis. Because I know that the whole market's going to go up, I only want to look for buys. So I'd only look for uptrends and buy whenever a stock starts to break above its simple moving average. Now the opposite can be true. Say you're an economist, or you have another way of kind of coming to a conclusion which way the market's going to go. So if this was a bearish market, then you could do the opposite of these rules. You could look to take a short position whenever the stock breaks below. So you can take a short position right around here, and you would want to see the stock continue, and you would sell out of the position whenever the stock breaks above and closes above your simple moving average. Does that make sense, what I'm saying? Any questions about this? So this is very basic. This is just one simple moving average. Okay. The next one I'm going to cover is a double simple moving average, or short-term simple moving average overlaid with a long-term simple moving average. The most common combination of these two is going to be your 50-day simple moving average and your 200-day simple moving average. So same kind of idea, except now we're going to use the simple moving averages crossover instead of price. So this is our short term. You can tell it's short term because it stays closer to the price. right? As where this one is a little bit slower to react because it's got a longer period. So how you would use this trading plan for the simple moving average crossover is whenever the short-term simple moving average crossed over the long-term right here, right there, you would want to look to sell your position or take a short. And then you would also do the opposite. Whenever this crossed over the long-term, we would get out of our short position if we were looking at a bear market. If we think that the market's going to go up, it would be opposite true. So we'd want to look to buy in whenever the short-term moving average crosses over the long-term simple moving average. Pretty basic stuff. I'm pretty sure some of y'all already knew these rules. Any questions about these? No? Okay. So I went ahead and listed out the most popular simple moving averages. The reason why you need to stick to these simple moving averages is because technical traders tend to stick in groups. So if we're all looking at the same simple moving average using the same type of strategy, there's going to be a higher probability that that trade is going to actually hit profitability or the take profit that we're looking at. So for instance, if you have 100 people looking at your 5-day simple moving average, there's a greater chance whenever you get a buy-in on that of the trade being successful versus something like a 3-day, which only like 10 people might look at, right? Those are just rough estimates that I made up. So the reason why I put period is because it's going to depend on the time that you're looking at. So for instance, if you are looking to day trade, this would be your 5-hour, 10-hour, 20-hour. For the longer term, for swing traders, which I am, you might be looking at daily to weekly. So this would be a 5-day, 10-day, 20-day, or a 5-week, 10-week, 20-week. So it depends on the time frame that you're looking at. Again, the most popular simple moving averages are 5, 10, 20, 50, 100, and 200. These are going to be your longer term simple moving averages. These are, I would say this is mid, and then maybe these two are mid, and then these are short term. Any questions about these?
You wouldn't happen to know if like the 20-day or 20-week would be more popular, or it depends on the...
Thank you, Ashley, for bringing that up. So what I would recommend that you do, each stock is completely different, and you might have people in, for instance, we were just talking about Ford, right? Ford, I would go ahead and list all of these out. Put all of them on your chart and see which one Ford or your prospective stock actually respects. So for instance, if you start seeing bounces off of the 50-day and it's constantly bouncing off of that 50-day, then you probably want to use your 50-day moving average for that particular stock. However, because some stocks are different, I can't say that this is going to work best. I would just plot all of these and see which one or see which strategy works the best. So if you're doing your short-term and long-term simple moving average crossovers, I would go ahead and list all of these out and then see which strategy would work most of the time. It's a lot easier to do and plot something like this because all the calculations are done. You're just looking for a crossover or bounce. It's not going to take you that long to figure out what works best for a particular stock. Does that answer your question?
Yeah.
Okay. Any other questions before we move on?